Thank you guys for coming out to our lunch and learn.
It's 11 o'clock.
This is one of the very rare occasions where I get to say not only do we know Rami to be good in his field, he teaches all over the place. We've actually, Irene and I, after I met Rami and he explained all of the things he specializes in and he teaches, as he was going through the list of things, I had to go, wait, the what? And had him back up. And I learned at least 3 things in a half-hour conversation that I had never ever come across before. And in total, what that has allowed Irene and I to do is apply for and receive HST rebates through being landlords of new construction properties. We didn't know that was a possibility before. So not only do we like Rami's sort of background, but we've actually used him as clients and been super happy. So what we've learned from that is that we're then going to be making sure that all of our clients know what we've been learning, and that's where these things really get valuable for you guys, right?
I want to keep on track.
So you want to know what he knows, but you also then want to pass that information on to your clients, hook your clients in with Rami, and now you become the person who has helped them get some money back that maybe they didn't know they were entitled to, or has helped them understand some of the benefits of buying new construction. And you know, the questions we always get, typically we say, well, you need to talk to a finance person about that. Now you'll at least understand enough to engage in the conversation and then have somebody that you can refer to. So thank you for being a solid service provider, as well as somebody that's taught us something, which is great. So Rami, everybody?
Yeah, I'll give you a little bit of background. That's me. I've been in financial planning for close to 30 years. Handed over my practice to my son a couple of years ago. This is my picture on our website, MCO Wealth. We're a sort of niche private wealth management company. This is my pretty daughter-in-law, actually, so it's a bit of a family business. That's my accountant. In any case, transitioning into HST, about 10, 11 years ago, 2 of my clients built new homes. And I knew that the rebates existed, because when you build a new home as your primary residence, you can get what's called an HST new housing rebate. So I helped them get the rebates. They're significant. In both cases, it was $16,080. Then I started networking with accountants and contractors and architects and designers and real estate, realtors, real estate agents, brokers, and realized there was a real niche and a real missing gap in the market, because 60–70% of the people I still talk to do not know about these rebates. They've existed since 1991. They were changed and tweaked in 2010. And they're still out there, and significant money, like I said, $16,000 for those 2 people. I'm not going to quantify the money that I got helping Philip get, but it's significant on 2 rental properties. And there are also very significant HST rules. So I want to keep this interactive too, so if you have, at any time, if you have any questions, just feel free to jump in, I'll answer your question, as long as we don't go too off track. So let's start with 2 very important points, okay? The rules and regulations with respect to HST and the rebates that I'm going to tell you about extend to all new residential real estate, except if you are, now the rebates exist, but the HST rules don't exist, except if you are building them or buying them for your use as a primary residence, okay? But if you're building for rental, let me ask a couple questions of all of you. Who here has represented an individual who has bought new construction, condo? Who here has represented a person who has bought new construction on assignment? You. Who has represented a person who has bought as an investment property for long-term rental? Okay. So in all those situations, there's some HST rules and rebates exist. And who here knows somebody, or even for yourselves, have either built a new home for yourself or know someone who has substantially renovated their home? By substantial renovation, I mean a 90% or more gut of the home. Anybody know people who have done that? Most of you. Most of, on my block, on my block alone, and I'm at Bathurst and Eglinton, there 1, 2, 3, 4, 5, 8 out of about 22 homes have either been newly built or substantially renovated. And all those
And that
people,
will be much more soon.
possibly, I mean, during COVID, it was going crazy anyway. It's been that way for a very long time.
Yeah.
So all these rules apply, and definition of new. New can mean brand new, you tear a place down, you build it, you build a new condo development, you build a new subdivision, all those are subject to HST. Or substantial renovation, which has a very distinct definition. It must be a 90% gut or more, and these are federal rules, not provincial rules, that those homes, if you take an existing home, gut it, sell it, it is subject to HST. So the other question I want to ask you is, have any of you represented builders who have possibly built new homes? And most of these contracts, your APS, your agreement of purchase and sale, will say, clause 7, page 2, HST is included in the purchase price unless it is subject to HST, and then whereby the vendor will supply, if it's not subject to HST, the vendor will supply some proof. There's a lot of non-compliant builders out there who try to sell brand new homes as resales. Why do they do that? There's no HST, there's no Tarion, there's no tax consequences if you sell a resale home. They do it for a number of reasons. The buyer of those homes is in a little bit danger because A, they don't have Tarion protection. They're not in danger of the HST because the contract says it's included in the purchase price. So let's go to the simplest one first. So you said you've represented an individual who has purchased a home as their primary residence, new construction as their primary residence?
Yes.
Okay, and you probably have too, and a couple others possibly. So that home is subject to HST, that condo, subject to HST. And depending on how the agreement of purchase and sale is worded, it's usually included in the purchase price. But in the agreement of purchase and sale, that buyer assigns the rebate to the vendor, and the vendor will give credit for that rebate back to the buyer. So I'll give you a numerical example so it's easier to understand. This was a client of mine. He bought for investment purposes. Now, the contract said purchase price $601,990, okay? However, he assigned the rebate, which it's a standard clause. So he assigned the rebate to the developer, and so now the price was $625,990. Now, how did they get back to this price? Well, the net price on this is $353,973.45, and you don't need to know these numbers just for interest purposes. The PST on that is $44,317.88, and if you just, this is 8% of this number, that's the PST. The GST is $27,698.67, that's 5%. And the rebate is $24,000, you deduct that, because you added it back up here, and you get back down to $601,990. Now, if you are buying for your primary residence, you will get credit for that on your statement of adjustments. They've added it back, but you'll get credit for it below. So it's a bit of a red herring, this rebate that you're getting. So that's for the primary residence. If you're moving in as your primary residence, you'll get that rebate on your statement of adjustments. There'll be a $24,000 credit on there. You don't have to worry about any paperwork, you don't have to worry about any HST consequences. Now, if you buy on assignment, so there's an assignee and an assignor, let's say I was the assignee, I was the secondary buyer, assignor signs the agreement of purchase and sale with the builder. He says, I've made some money, that happened, not seem to be happening much anymore, but 3, 4, 5 years ago, assignment sales were heavy duty because people were making profits. So I, as the assignee, then step in, sign. Now I've got 2 agreements of purchase and sale. I've got one with the developer, I've got one with, I take over the agreement of purchase and sale with the developer, and then I've got one signed between me and the assignee and the assignor. And so I won't get credit for that rebate on my agreement of purchase and sale. I must apply for it afterwards. It's a timing issue. So the primary residence will pay this. Me as the assignee will pay this, but I then have to apply for this to get me back down, to put us all on equal footing. I must apply for the rebate as an assignee, I must apply for the rebate after the fact, and I meet tons of people who don't know this, and they're sitting on 24, 21, depending on the price of the unit, it's usually $24,000. They're sitting on $24,000 if they bought on assignment. It's the same thing as if you buy on for investment purposes. If you buy for investment purposes, you must now also apply for it afterwards. They will only give credit to you on the statement of adjustments if that condo or if that subdivision home is going to be your primary residence or the primary residence of immediate family. And immediate family means parents, siblings, children. Okay? No farther out than that. And fairly clear so far? Okay. As an investor must also apply for the rebate. And I gave a talk like this in 2019 to PSR, downtown on the King Street office. After it was all over, a young broker came to me and said, Rami, I bought a condo for investment purposes in 2017. I said, when? The seminar was in May. He said, in June of 2017. I said, there's a 2-year limitation period. We're about 3-4 weeks away. Give me all your paperwork. I got to get it in. Unknown to him, he was sitting on about a $21,000 to $22,000 rebate. A few weeks later, it took about 3 months actually, 3-4 months. He got his money back. Had he waited another month, it was gone, poof of smoke in the air. Now, do your clients who have bought on assignment know about this?
Yeah.
Yeah, okay. Your clients who have bought for investment purposes, and you're more informed more than likely, and you let them know. Or their lawyers let them know, or their agents let them know. Or
Lots of people don't know.
lots of people do not know. I would still say maybe 40 to 50% do not know that they can get this money
Accountants would
back.
know. Accountants know.
Accountants do not know.
They don't?
Believe me,
Oh,
these are rules, accountants know rules that apply to the Income Tax Act. All these rules that I'm telling you with respect to HST are governed by the Excise Tax Act. Accountants who specialize in real estate, some of them will know. I've taught David a thing or two about these rules because he didn't know. He didn't know. I mean, your client buys a new home. First of all, he may or may not tell you that it's brand new construction. He may or may not tell you, their accountant, that it's for investment purposes. So they probably will because there will be rental income coming in. They may not tell their accountant that it's bought an assignment if there's primary home. Oh, I bought a new condo. Well, will the accountant say, is it a brand new condo? You may be eligible for a rebate? Tend to doubt it. For most of them, anyway. Okay. So let's get back on track here. So, brief history of HST. 1991, they created GST. The federal government said, hey, new residential real estate was no longer was not subject to HST until January 1st, 1991. We're going to give some of that GST back. And it's a maximum of $6,300 as long as the value of that new residential property is below $450. And it's a graduated scale. It doesn't really exist anymore for new condo developments, new subdivision developments. It may exist for the very hot topic of laneway homes, which we'll get back to later. July 1st, 2010, HST was created. They merged GST and PST. All of a sudden, new residential real estate was subject to an 8% surcharge because prior to that date, it was just 500,000 plus 5%. Now it's 500,000 plus 13%, another $40,000. The government was lobbying, not the government, the developers were lobbying the government to say, this is no good. All of a sudden, you're increasing the price by 8%. Throw a rebate in there. They do throw a rebate in there. It's worth up to $27,300 in certain conditions. But again, if you're buying a $500,000 condo, which is only subject to the provincial portion of the rebate, and you'll only get back $24,000, the government is still keeping 16 of it in their pocket. And as you go up the scale to $1 million, which is subject to $80,000 of PST, again, the government is only giving back 24,000 of that 80,000, and as you go up the scale, and you go up the scale, and you go up the scale, eventually that rebate will become more or less meaningless because $16,000 or $24,000 a day is not worth what it was 10 years ago. Buying power of money, obviously, inflation. Now, so we've talked about assignment, we've talked about how the rebate, well, the rebate is received by the primary residence as an adjustment to their statement of, as a credit to their statement of adjustments. To the investor and the assignee, it is a check or direct deposit for $24,000 after filling all the paperwork in. It is not considered income, it is a refund of sales tax paid, okay? Now, what to know if you're representing a builder of new residential real estate? As I sort of touched on, have any of you represented clients who have bought new real estate that was sold by a small developer, like a small home? You have. Were there arguments about...
It was a disaster on all fronts.
On
actually.
all fronts? Give us an example of the disaster. Terrion was a disaster because what normally...
They ended up using Terrion. The builder went bankrupt halfway through the complex up in Collingwood,
Okay.
it was in Meaford actually. And the new build was, you know, just fraught with problems the whole way along.
Yeah.
And, you know, no rebates, no, you know, it was,
Well, there could have been rebates.
well, I mean, they applied for rebates.
They applied, okay.
Yeah, because it wasn't an assignment, it was an original construction, but it was a recreational property for them.
Oh, okay, a secondary property.
Yeah.
Yeah, there's no rebates for secondary property.
So
The
that-
rebates only exist for primary residence or for residents that will be somebody's primary residence, like a long-term renter. It doesn't exist for secondary property. So if someone said to me, Rami, I'm building a brand new cottage up north, or I'm totally gutting my cottage up north, am I eligible for rebates? No, it's your secondary property. It's not your primary residence.
The builder didn't know that.
Oh, okay,
The
but,
builder thought they were building primary construction for all these people, not,
okay. That's sort of unimportant for the builder, really.
yeah.
But I'll tell you what happens. You know, often, and I get a lot of referrals from real estate agents who say to me, Rami, my client just bought a house, a new house, from this developer. Do you think they're eligible for a rebate? And I will say, okay, I will do my due diligence. I will say to them, okay, yes, there's a new building permit issued by the city of Toronto or whatever municipality. Number two, the builder in this case doesn't have to be a corporation, but in most of the cases that I'm dealing with, it's a corporation or an individual. I say, okay, it looks like they're selling it for a profit, so they meet the definition of a builder in terms of the CRA. And the definition of a builder in terms of the CRA is if you have an interest in the property and you're selling it for a profit. You're conducting a business activity, basically. And three, are my clients, or these people that you sold for, are they the first in? And generally in these cases, the building permit's clear a week or two before, you know, they're moved in, because the builder doesn't have time to do it until they've formally sold
Can I
it.
come through that?
Yes, sure.
Sorry, apologies guys.
Okay.
I'm gonna come to
So
the-
I say to these agents, yes, it looks like from my point of view, your purchaser, your client is eligible for the HST rebate. However, there's one thing you have to understand. If I put all this together, and it's not my decision to make, and they are granted this rebate, your builder, let's say it was let's say they bought it, just ease of math, $1.130 million, which means the net price really, since it was subject to HST, was $1 million plus $130,000 of HST. You've signed a contract, your agreement of purchase sale says HST is included in it. I'm gonna get your people the rebate, they're gonna go after the builder for that $130,000 that your client has implicitly paid. And even though the agreement of purchase and sale says so, and the statement of adjustments will disagree because those statement of adjustments never break out the HST, the agreement of purchase and sale is the contract, that is what the government will look at. And I just want a case going to federal court, tax court, that say, no, you're denied the rebate because the statement of adjustments did not break out HST. And I said to them, well, I've proved to you it's new construction, I've proved to you that the vendor is a builder, I've proved to you that, that they were the first in, and the court relented and said, you're right, we're giving your client the $24,000. Okay? Now, they may go after the builder for this embedded HST, because they collected it and they did not remit it. Okay? So I caution you when if you're there's no problem for you as agents, as realtors, if you're representing the buyer. But if you're representing the builder, take care, because if it goes bad on them, they may come after you and say, you didn't tell me that the house was subject to HST. And you maybe would consider, I would consider, and I advise realtors, So you get your builder, if you're representing that kind of builder, to say, consult your accountant, consult your tax lawyer, consult your other experts in this area. I've advised you there may be an HST issue to get you off the hook. Because if there's a case, they'll bring everybody into it to try and recover their money. So I always caution people, and I've done this many times for people, getting them this money back from these non-compliant builders. And it's not just new construction. If you take a bungalow, you turn it into a 2-story, gut the interior of the bungalow, push it back, so you take a 1,200 square foot bungalow and all of a sudden turn it into a 2,800 2-story home. Even though you've not taken down all the walls of that bungalow, you've kept 3 up. It's still, by the federal government, considered new construction, and if you're selling it, it is subject to HST. Okay? Okay. Now, as I said, going back, if you buy for investment purposes, you must apply for it after the fact. You must have a 1-year lease in place. You must have closed, because you can have a rental agreement in place during interim closing, but in order to claim for the rebate, you have to have both things in place. You have to have paid the HST, taken ownership, and have that 1-year lease in place. The clock starts on that not when the lease starts, the clock starts when you close the property, 2 years from the date. That's actually 2 years from the end of the month following the day you close. But I just tell people for simplicity, it's 2 years from when you close can you apply for the residential rental property rebate. Okay? So there's 3 rebates in place here. There's when you purchase from a builder, but as I say, if you purchase from a builder for your primary residence, you don't have to worry about any paperwork. It's all handled for you in the agreement purchase sale. If you buy an assignment, you must apply for it afterwards. That is called the GST HST New Housing Rebate for houses purchased from a builder. If you buy for investment purposes, it's called the HST New Housing Rental Residential Rental Property Rebate. Okay? And again, there's 2-year limitation periods for all these rebates. The third one is if you buy and build for, if you build for yourself, or if you renovate for yourself. So if I was to take my existing home, tear it down, build a new home for myself as my primary residence, I would be eligible for what's called the HST New Housing Rebate for owner-built houses. I don't have to hammer the nails into the wall. I can hire a contractor, I can be my own GC, I can hire trades, I don't have to hire trades. That rebate is for an existing house that you tear down or an existing house that you gut to the extent that the substantial renovation meets the criteria of new construction, which is a 90% gut, is eligible for a rebate of $16,080. It can be as much as $24,000 if you buy land, pay HST on that land, and build. Then you can get $24,000 back, because you get an element of the HST that was paid on the land back.
Is 24,000 the maximum rebate?
It's the maximum rebate if the home is worth more than $450,000. If the home is worth less than $450,000, you could get an element of the GST back. So the $24,000 is 75% of the PST to a maximum of $24,000. Okay? As soon as you exceed the $450,000, you're only eligible for the 24. If you are anywhere from 350 to 450, it's a graduated scale, and you can get a percentage of the GST that you paid or you spent back. So the formula is a little bit complicated, but I'll get into that with laneway homes, because that's another interesting area where I am getting people back greater than the 16,080, not greater than 24, but greater than the 16,080. Because the 16,080 is generally the maximum you can get back if you tear a house down or substantially renovate a house for your own primary residence. Throwing a lot of numbers at you, throwing a lot of different scenarios at you. I don't expect you to remember. You have my card, you do not. If you have any questions, feel free to reach out. Best way to reach me is on my cell phone.
Can I get a card? Yeah, that's what
Yeah, sure.
Just to go off what David just asked in
Yes.
regards to the maximum rebate, and you said that's for a house that's worth over $450,000. Now, does that mean, is that 450,000 for how much it cost to build that house, or how much?
No, it's the fair market value.
Purchase, okay.
It's a fair market value. And in fact, what happens with the rental rebate is, let's say somebody, in an escalating market, let's say somebody bought it for $350, but in the 3 or 4 years it took to build, the market value went up to over $450. You won't get back the GST, you'll only get back the PST portion of the rebate. So you'll be sort of out of luck there for some of the rebate. It's based on fair market value. Now, it's not based on fair market value for your primary residence, but it's based on fair market value if you bought an assignment, and like there's a secondary application that has to go in.
Out of curiosity, what's gonna happen to everybody who's assigning properties now for less than they bought them for? Is it based on the contract or the fair market value at closing, which could potentially be less?
It could potentially be less. It could potentially be less. If the fair market, if you bought it at a lower price, it's based on that lower price that your rebates will be determined. But you've already got, if you're buying an assignment, you've already got an agreement of purchase and sale that you're taking over from the builder. So you know, the builder doesn't care that the fair market value has gone down, right? So you have a contract that says $500,000 with the builder. You have to pay HST on that value, regardless.
But the rebate is effective.
But the rebate may be affected, I'd have to look at the scenario. It hasn't happened very often, if at all, in my experience, but it's possible. It's possible.
We're heading that way now.
I was gonna say, it's like,
Let's talk about, let's talk about accessory dwelling units. Let's talk about laneway suites, ADUs, garden suites, garage conversions, etc. I've represented a ton of people on these, got them significant money back. Now, so you decide your property is eligible for an ADU, you hire your contractor, you hire your architect, hire your contractor. Sometimes you do it yourself, very rare. And you build it, and let's say it costs you $450,000 to build, okay? And let's pick an easier number, $452,000. We don't have an eraser here, but okay. Don't worry about it. Maybe it's back here. Oh, okay.
oh, there's an eraser.
There's
On the head.
not an eraser, where is it? Sorry, it's pointing right there.
It's right there, right?
Oh, that's all right. No,
No,
that's not right.
I just moved one a few minutes short.
Okay, listen, I'll use my hand.
Hold on, no, let me get you one. Hold on a second.
Okay, so let's say the laneway home, they can cost anywhere from 300, even 200, these new modular homes. I'm just doing a rebate for somebody out in Niagara who is actually, he built it for his mother-in-law. He's in the business, it's a company called FlexoBuild. They did modular homes. These modular homes are gonna cost about $200,000 and maybe $250,000 with everything else in that you have to do to get it in the ground. For about between a 500 and 600 square foot unit. His mother-in-law is there, so it's generational housing. That's a lower value, but thank you. Let's talk about the GTA experience more than the, outside the GTA experience. So more people are searching these alternatives for lower cost. The conventional costs for these laneway homes is greater on a square foot basis than it is for a standard home. Thank you, David. So let's say the laneway home, including, our architectural fees and a little wet stuff. Surveys, engineering, it comes in at $452. And that's probably like about a 500 square foot unit, possibly. There's $52,000 of HST. This includes HST, so 400 times 13% is 15. So that's 13% of 400K for a total of 452. Now, if you are building it for generational housing, it is eligible for the HST new housing rebate for owner-built homes, just as the same way If I were to take my house down and put a new one up, I'd be eligible for that, okay? You have to be able to show that it is it doesn't have to be just for yourself. Now, if it's for yourself, you have to move out of the main home. You gotta make that laneway home your primary residence. Either let other family members, let's say, adult children who are having trouble getting the market into the main home, or you rent the main home. But this laneway home, if it's gonna be my primary residence, I have to vacate the main house on the property. Or it can be for your parents, elderly parents you wanna keep close, or it can be for your children, or it can be for siblings, and it can even be for an ex-spouse, okay? Those are the people that you can build that laneway home that will be eligible for the HST new housing rebate for owner-built homes. Now, I said ex-spouse, and people are probably thinking, why the hell would you want to live near your ex-spouse? Well, let's say you had a decent relationship with them, and you wanted joint custody of the kids, you know, and you're close. And so you don't have to travel back and forth in the city. You know, I know some divorced couples who still get along very, very well, and their kids are doing well because of it. In any case, that's a whole different story.
Is there like a certain amount that it has to be to get a rebate? Like,
No.
say the laneway house cost only $100,000 to build,
Yep.
they'd still get 13%.
I'm doing the one that I just mentioned. The value is $200,000. This person will get between $10,000 and $11,000.
Which is the 13% you're saying, isn't it?
No, you get a portion of the GST and the PST back. You don't get the whole amount back.
Oh.
Okay, so so you spent 52, I'll show you what you get back in this scenario, okay? So in this scenario, what happens with these laneway homes, they're non-severable. And you cannot sell them separately. So to try and determine the value, the fair market value, is a little bit difficult. I've talked to real estate agents, I've talked to appraisers about this. I don't know, you guys know a fellow by the name Barry Lebo?
Yeah.
Yeah.
Very well known. He's he used to be probably the most prominent appraiser in the country. He's still practicing after 55 years as a real estate agent. He's in court at tons as an expert witness on, for and against real estate agents, I guess. Oops. But in any case, I talked to Barry about this at length. And he says, well, until there are more comparables, it's tough to determine the value. And I said to Barry, how about this? If I go to a realtor and I say to them, what is this property? You know this area well, and I'll go to a realtor who knows the area well. What is the value of the house if you take out the real estate, if you take out the laneway home? And they'll have a very good idea because there's resales in the neighborhood. They know they know the area, they know the size of the lot, they know the size, they know the finishings, etc. And they'll say to me, I think this home in this market is worth $1.5 million. Okay? And then I say to them, okay, put the laneway home back in. What do you think? Because it's non-severable and because you can't sell it separately, what do you think it has incrementally increased the value of that property by? They'll give it some thought, and without actually prodding them for a value, they usually come very close to this value. And in many cases, they will say, let's say it's worth $400,000. That means that at $400,000, you would be eligible for a portion of the PST, which in this case is $16,000. And in the case, which is the rebate, R for rebate, and in case of the GST, because it's below $450,000, and the way the formula works, the maximum rebate is $6,300, but that's at a $350,000 valuation. Don't worry about how I'm getting these numbers. They would get an additional $3,150,000 back for $19,230. That would be their rebate on a laneway home that is valued at $400,000.
Rami, can you just tell me again, what's PST amount again and GST amount? I think it's 6 and
8 and 5.
Is it
8 and 5, yeah, 8 and
8
5.
PST?
Yeah.
Okay, thanks.
I wouldn't worry too much about these numbers, but go ahead.
And that again maxes out at 24,000, right? That's,
No, on this type, it would be tough to max out at $24,000. The most you could get in this is the maximum PST, which is $16,080, and the maximum GST, which is $63. So on this, for owner built, it would be $16,080, so it would be $22,380 would be the maximum for that.
So you're on a 452 contract or cost to build, you're backing out the HST. On a 750 cost to build, you're backing out the HST, but you're still capping at 24 on the rebate.
Well, not on this kind of rebate. The max on this kind of rebate would be $16,080 on a $750,000. You're confusing the few rebates. On this one, which is the HST new housing rebate for owner-built houses, the maximum rebate is always $16,080 if it's worth more than $450,000. And in certain cases, like in this, where the laneway home is worth $400,000, you can get $9,230 back, and the maximum rebate is $22,380. I wouldn't worry, I would say, if you've got clients who are doing this, just tell them, there's a significant rebate out there of somewhere 16,000.
So here's my question.
Yeah.
Sorry to jump in. They're gonna need a letter from you, the realtor, to say this is the market value of this, because they have to apply for this rebate.
Right.
And you have to sort of demonstrate.
If it's $450,000 or more, you don't need it because you're maxed out. If it's less than $450,000, I've got many opinion and value letters by the realtors saying, based on my analysis, this is worth $450,000, and there's always a proviso there that, you know, to protect your.
So, but they're gonna need something like that
Yep.
when they apply.
Yep, exactly. And I've got tons and tons of opinion of value letters
I haven't been
from.
asked to write a letter of opinion on a laneway house yet, so this is an intriguing.
If you want some samples, I can definitely send you some samples. Reach out to me on my email and I'll definitely send you some samples of what other real estate agents have written. Some are more comprehensive than others, some are pretty concise, saying, hey, asked to provide an opinion of value for this laneway home. It is a separate, distinct unit. It is non-saleable, non-severable, non-saleable. I believe it's increment, and you know, they describe it in short detail. Hey, it's a one-bedroom, 400 square foot, or 450 or 600 square foot unit. I believe it has incrementally increased the value of the property by such and such.
Do rebates change if the property is separate and severable?
It might be, but where does that happen? On a laneway home, the rules as they apply now don't allow you to sever and sell.
Oh, there was examples 20 years ago of properties built on laneways that were severed with right-of-ways over the side.
Right, that's 20 years ago.
Right.
That does not exist today.
It does
But
not.
if it does exist today, then it's a very different formula, particularly if you're building for rental. This is the easy rebate. If you build that laneway home for rental, it becomes a much more complicated issue, and I will tell you why right now. As I told you, because these type of residences, if you're building them for immediate family member or your own use, they are exempt from HST, okay? They are primary residence of your immediate family. And when you sell that property down the road, that laneway home is also not subject to HST. But if you build for rental, and this is important, remember what I told you. If you build for a profit motive or rental, then it is subject to HST. And you'll say, well, you're not selling it. How is a rental property subject to HST? And I'll give you an example. Let's say I had two properties, and I decided to build two homes on each of the properties. You know, here they are, here are my properties. And one, I decide to build for sale. It's new construction, it's brand new construction.
Pizzas here?
Okay,
Yeah,
okay.
I'm gonna grab that and I'll bring it back to you, thank you.
One, I'm doing for sale, and one, I'm doing for long-term rental, not short-term rental. It has to be, you know, 1 year lease, or even 2 year back-to-back, or even 6 month back-to-back leases. There can't be any gaps. So let's just assume it's a 1 year lease. Both are new construction, both are identical. They look identical. The properties are identical. They're mirror images of one another. You see those properties go up, you know, from time to time. I always look at those properties and say, I wonder if the builder is doing that right. Anyway, it's subject to HST. This one is easy. You sell it for $1 million plus HST, $130,000. You collect that from your purchaser, and you remit that $130,000 to the government. You can deduct what you spent on construction and HST against that $130,000, and that's what you have to remit, okay? If you're building new for sale. Now, this is my property as well. I'm building it for rental. The government says, well, we want to put everybody on equal footing. You're not selling it but it's subject to HST, and I think, maybe I'm not too sophisticated, I said, well, when I sell it, it'll be subject to HST. No, because at that point, when I sell it, 2, 3, 4 years down the line, it'll have been occupied, and it's considered used residential property, and it's exempt. So on the day, so let's say I sold this on September, no, just the other day, October 1st. I sold it on October 1st. And on this one, I rented it on October 1st, and it was occupied on October 1st. On that day, I must determine the fair market value of that property. Well, I know that I sold an exact same property right next door for $1 million. So it is termed a deemed disposition. I am both vendor and seller, and purchaser. I'm both vendor and seller on this transaction, and purchaser on this transaction. I have sold it back to myself. There's no paperwork involved. It's just a rule of the Excise Tax Act to put these two type of transactions on an equal footing. This one is charged and collected HST. Well, this is new residential real estate subject to HST, so the day it becomes occupied, I must determine the fair market value. It's called self-assessment. In this case, it's easy, because I know what I sold one for right next door. I owe the government $130,000. I can deduct all the HST that I spent on construction, and as a landlord, I can claim, as the builder and landlord, I can claim the HST new housing rebate for $24,000 against that $130,000 that I owe, deduct the HST that I spent, and deduct the $24,000, so I'll have to send them a net check of $70,000, okay? This is what people don't realize. Lots of small developers are, oh, did he leave?
Yeah, Christine, thank you.
Did, oh shit, I should have given him some money. Is he going? I wanted to give him a tip. All right. Anyway,
I didn't know.
I should have thought of that, sorry.
No, no worries.
Now with laneway homes, it's a different story. So with laneway homes, because you cannot sell them and sever them, and because the land value is difficult to determine, the numbers work much better for those people building it. Because in that previous example that I gave you, if it costs $452 to build, which includes $52,000 of HST, is embedded in there, and it's worth 400, well, you owe on that 400, you owe 13%, so you owe $52,000, okay? And so what you owe the government is offset by what you have spent on HST, so now you're in a zero position. You owe them 52, you spent 52. This is the way the numbers are working, because laneway homes are such an unusual, garden suites or whatever you want to call them, garage conversions. Again, because you cannot sell them separately, because I believe these things, and for a number of reasons, they reduce the number of buyers, because not everybody wants a laneway home. They want full enjoyment of their property. They take away parking, which may decrease the value of the property somewhat, because parking in the city is a valuable commodity.
Laneway parking.
Exactly. Other reasons, they're very expensive to build. We're in a bit of a down market, and so these things are not in the immediate term. These things are not recovering necessarily what you spent on construction. Most people don't care because they're not planning to sell them. They're planning to hold on to them as long-term investments. Most people who I represent live in the main house, and this is an extra source of income for them, or it's an investment property that they're planning to hold long-term. But, okay, so now we're at a zero position, but the rental property rebate on a $400,000 valuation is $27,150. Just the way the numbers work. David, I know you're intrigued by how these numbers work. Don't worry about it, that's my job. But the numbers for real estate, for rental property, because there is an element of land included in there, and the government figures it out that way, it's a much bigger rebate on this. If it was worth $450, then you'd only get that $24,000 back, because you're not getting the GST portion back.
So that 27.5 is an added benefit of being 400 or less. If it was 400 or more,
well, as you get
qualify.
closer, let's say it was 449, here's how it works. It's 450 minus the value of, so this is 450,000, minus the value of, the fair market value over 100 times 6,300, okay? And in this case, that's 50, sorry, over 100, not 1,000. So 450 minus 400 over 100 is 50%. 50% times 6,300 is 23,000, is 3,150, so it's 24,000 plus 3,150 of GST. If you go to 449, well, it's 450 minus 449 over 100, which is equal to 1%. Well, 1% times 6,300 is $63. So you're only going to, it's a sliding scale as you get closer to $350,000.
So I misunderstood. I thought it was the 24 plus the 27. It's the 27 as a whole?
27 as a whole.
24
Yes.
representing a portion?
Yes, 24,
Plus a portion of,
24
The
of PST rebate
okay.
and 3150 of GST rebate. Excuse me for not explaining that.
No, that's fine. It's not you, it's just,
Okay. No, it was me.
I'm trying to keep up.
I should have explained that wrong. So people, I have probably done this 40 or 50 times with people, now it takes a very long time, but they get significant money back. And it's not income, it's a return of sales tax paid.
Is that return of sales tax paid, is that a taxable benefit?
No. Absolutely not. You do not have to declare it as income. It's just, you paid sales tax, they're getting some of that, you overpaid your sales
I'm
tax.
just so used to paying tax on everything.
Well, I had somebody come up to me last week after they got their rebate check, said, Ronnie, it's the first time I've ever gotten anything back from the government. Thank you very much.
So, just to deviate modestly, you're looking at a 500 square foot, garden suite,
Yep.
laneway house, and knowing average costs right now are about $400 to $450 to build per square foot.
Yeah.
It almost, no one's gonna make the decision to build less for the sake of an HST or the sake of a $24,000 rebate. So
No.
this, depending on the cost, this has some benefit, but not an exceptional amount.
People have already made the decision to build a laneway home, but they're not aware that they can get this money back.
Yeah,
So it doesn't factor into their decision, but what I do tell contractors is have your discussion with your clients about this, because perhaps they will, if they know that there's 20, 24, 27,000 coming back on the back end, maybe they will upgrade this, or maybe they will upgrade that. And it's, it's just a wise thing to let their clients know that this is at the back end, but this is not governing their decision to build a laneway home. But however, when I tell people who have finished their laneway home and who don't know about this, you don't think they're happy, David? They're
No,
extremely happy,
No, I don't want to underestimate what the benefit that you're adding to the conversation might, from my perspective, if
Yeah.
you're spending $650 to $700, the 24 is not a determining factor.
No,
But it's
you're still getting
definitely-
5% back.
It's a nice surprise, and then us knowing that it's there is absolutely gonna help with us, it's
Yeah,
like separating
selling a
us
property.
as an industry expert.
Exactly.
There's benefit to us as well. I'm just, the cap at 24.
It's a little confusing.
From a tax perspective bothers me, because there's more there than we're getting back, but that's fine.
Right. Well, go ahead.
Just a second. How does capital gains tax fit
That's a
in?
whole different aspect, but
Right.
I'm happy to talk about that because given my financial planning background, I do understand it. If you are building that home as secondary residence, as generational housing, there are no capital gains, it's exempt. If you are building it for long-term rental, that portion that applies to the laneway home will, upon sale, be subject to taxation.
But only for the years that it wasn't occupied by a family member.
Exactly. Well, if, let's say, you built it strictly for long-term rental.
Isn't that true of basement suites and primary residence as well?
No, basement suites, because because you're still occupying greater than 50% of the home. Yeah, I would say most accountants would say, ignore it. Maybe by the true letter of the law, you might be able, the CRA might be able to argue that perhaps it is. I've never seen a case where they've come after it. It's listed as your primary residence. They won't come after you unless you know, you occupy, if you occupy less than 50%, let's say there were 4 units there, and, you know, the rules now say you can build 4 units in a house, and you only occupied a quarter of them, or, you know, 25%, then upon sale, it's not your primary residence anymore, because, you know, 3/4 of it are occupied by other people at their primary residence, and so it would be subject to capital gains. But only at that moment when it changed from, you know, 100, you know. So on that capital gains question, the moment that, and on that capital gains question, it wouldn't be based on fair market value, it'd be able, what you spent. So your adjusted cost base would be at $452,000. If you decided to sell it in 5 years, and that 452 in value relation to the whole property went up to 600, well, 150 of that would be capital gain, half of that is taxable, you owe tax on an additional $75,000.
I have one more stupid question.
Yeah.
What if the house was owned by a registration or it wasn't registered to a person?
Well, if it's an investment property,
No, like if I start buying property
Yeah.
as a corporation and name my kids as subsidiaries of the corporation to avoid all the shit down the road, and then we do this.
I don't understand what you mean.
Like if I-
Ultimately, there's one owner of the property, you're on title. If the corporation is on title,
Yeah.
when you sell it, it's gonna be subject to taxation, right?
Right.
But if you build a laneway home,
While I own the property as the corporation.
right, you're still eligible for rental purposes, you are eligible. And the only reason, well, I guess you could use your kids to move into it, but you wouldn't be, because a corporation cannot meet the definition of a direct relative of that individual occupying it, you wouldn't be eligible for the rebate if it was a kid or a parent moving into it.
Right, but if the corporation was owned by me and my children, then my kids took the rental suite and I took the primary residence.
If they pay rent,
No.
no, there's no rebate there.
Okay.
There's a distinction, there's 2 entities there, there's
Yeah.
a corporate entity, there's a personal entity, and even though you are moving into it as your primary residence, it's the owner of that property that must make that their primary residence. And if it's a corporation, they don't meet that definition, even though you own the corporation.
Yeah, question. You own the corporation and you die, okay? What is the best way that your kids will get?
Are you asking me? I don't know, I've been trying to figure out ways to not
Make
give
them
government money
shareholders
for
of
the
the
last 10 years.
corporation. You'd want to make them shareholders of the corporation.
Shareholders,
Yeah.
okay?
But talk to an accountant about that, or a
Yeah.
tax lawyer about that.
Isn't that you?
I'm not a tax lawyer, I'm not an accountant. I'm a financial planner who knows a lot about HST.
All right.
There's my accountant, there's my accountant right there.
I think they trust, but then they get, anyway, a lot of my clients ask me that. That's
Yeah.
why I'm bringing up,
Well,
The
you should tell your
estate.
clients to talk to a good tax lawyer or a good tax accountant.
gotcha,
Yeah.
okay.
Yeah. That's what I tell people. I can give you the general information,
Yeah.
but talk to the experts, the real experts. Yeah, go ahead.
Right, so what are the rebate implications if you build a laneway house
Mhm.
for generational living and then it turns into a rental, like
Yeah,
years
maybe.
down the road?
No, because now at that point it's become used residential, so you can only collect one rebate. You can't
Yeah.
collect it for primary residence and later on, oh, I turned it into a rental, turn it into something else, okay? Now, third, there's really basically four reasons for building a laneway home. One, the least common is extra room for your house, you know, rather than building an addition, you decided, you know what, I'm gonna build a laneway home, I'm gonna use this for office space, I got teenage kids who are making a lot of noise with their friends in the house, they can move out there when they're entertaining their friends, I'm gonna do that, and down the road, maybe I'll turn it into a rental, or maybe down the road, I'll turn that into my primary residence, or maybe down the road, I'll turn it into a long-term rental. That has no implications at all, okay? The second least common, so if I'm going 1, 2, 3, 4, is short-term rental, and I haven't touched on that. That is considered a commercial activity, and as a commercial activity, you can claim all the HST that you spent on construction as input tax credits. You guys have input tax credits. You've got registration numbers with the business department of the CRA. It starts with a 7, 8, or a 1, probably 7 or 8, and you can get this full $52,000 back. Moving forward, when you charge rent on short-term rental, it's all subject to HST. So the government says, well, we're giving you this $52,000 back. It's all the ITCs that you spent getting this business off the ground, all future rents are subject to HST, and that's how we'll get that back. My most extreme example of this is a guy in the annex. He was turning a single-family home into 4 units that he was planning. He called me. I got referred to him and said, Ronnie, I'm so far into, I'm in $1 million in this thing. I spent over $100,000 of HST on this, and I don't have any money left to continue. Where can I possibly? And he was doing this with family, and they were financing here and financing there. I said, well, what's your long-term intent for that? He said, it's for long-term rental. I said, well, you're going to be in a big, deep SHIT load of problems, because when you do that fair market value assessment, as I told you, and that property that you bought for $1 million, you put $1 million into, and let's say the fair market value assessment is $2 million after you finish, you owe the government $260,000 in HST on that deemed disposition the moment that renter or those renters go in there. Well, you can deduct all the HST on construction, which is, about $100,000, so you'll have, and I'm sorry, it was 3 units, not 4. And you have, and the numbers were even more extreme, actually. It probably would have been worth $3 million. So let's say 390 less the 100,000 plus 120 on HST, still owes 270, plus 96,000 for rental rebates, because you can get 4 rental rebates. $96,000, so 390 less 120, 270 is 96, let's say 100. He's still going to owe $170,000. I said, I'm going to owe $170,000 to the government? I said, yes. I said, however, I said to him, do you have expertise in short-term rental? He said, yes, we own a property in Vancouver. We do Airbnb and short-term rental all the time. I said, well, if it's short-term rental, it's a business activity. You can get that $120,000 back. Got the paperwork done for him, go through all his invoices, list them, send it off to the government. They fought like crazy because they don't like giving up money, but he got his check for $120,000 last November. A year ago.
Did they ever audit the actual use of the construction?
They may, it's a good question, they may. But it's easy to audit because he's correcting rental on it that he's charging HST on. He's got a registration number, so easy to check whether he's charging HST or not. If he converts that now to, now you ask about conversion. Because short-term rental is not considered primary residence, change of use triggers self-assessment. So I said, you can never change the use, it has to stay the way it is, because the moment you change from a business activity to residential property, that residential property is now considered new. It's never been used as somebody's primary residence before. It's considered new, you have to self-assess. You will owe the self-assessment value, which in 5 years' time, for example, could now be worth $4 million. You owe the government, $600,000 potentially. So if it's going to stay short-term, it must stay short-term.
4 units, can you do 2 and 2?
Now I know why a lot of the sellers in the annex are selling.
Possibly. 2 and 2, how do you mean 2 and 2?
Like if you were...
Too long-term, too short-term?
Yeah.
You don't want to get, you get into, you'd have to do a whole complicated, it'd be complicated. It'd be complicated, because part of it would be short-term subject to HST, there would be self-assessment.
Okay.
And part of it, yeah. I warn people not to turn into mixed usage, because it's going to cost your accountancy and everything else, you get a lot of headaches. Okay?
So is your financial planning service, or do your services extend beyond, like, is this an aspect of what you do, or is this your primary focus?
Well, no, my primary focus is this, so let me tell you, I'm not doing this for altruistic reasons, just to give you information. I do these applications for people, and I charge them to do these applications. So if you're an assignee or you're an investor, and that's what I did for Philip, he bought 2 investment properties, I put his applications together, he's gotten 1 rebate back, he's waiting for the other rebate, and then Philip will owe me some money. If you're building as an assignee and you have to apply for it afterwards, I'll do the paperwork for you. Those are generally inexpensive. Something that I did for Philip and something that I do for someone who buys on assignment, it's about $400 plus HST to put the paperwork together. You're getting $20,000 to $24,000 back.
And is it primarily Ontario-based, Canada-based, like do you do tax rebates and other?
No. Now, these rebates do exist in other provinces that have HST, I was doing it for Vancouver for quite some time until so I started this in 2011. I did it out in BC for 2 years, but then by referendum they got rid of HST. It only exists, the provincial side of this only exists because the provincial portion was added to residential real estate when they created HST. So I did it in Vancouver for 2 years and you know, then couldn't do it anymore because the GST portion is only there. These rebates exist across the country for the GST portion except for Alberta. But only exists for when you're at less than $450,000. And I have done it in small towns where real estate is worth $200,000, $300,000, $400,000 and gotten people just the GST rebate back and the portion of the PSB. Yeah. So no, my function is now, I'm still involved in this practice because after 25 years, I have clients who still want to see me, right? I've developed long-term relationships with these people and they say, well, we like your son, but we still want to see you. So we go join meetings, you know, these people eventually.
But no, I'm just questioning more like, as we look at real estate now, Toronto from an investment perspective is getting a little expensive. As we look at people who are asking to go down to Florida or Arizona, or like there's rebates and opportunities for reimbursement there as well. I was just wondering if that was in your
I
wheelhouse.
don't do US, no.
Okay.
Yeah, so when you're doing a rental rebate for a laneway home, my fee is like $900 plus 4% of what you get back. So usually you're getting 24, you'll pay me $1,800 to $2,000 back. But here's the bonus for people: I do not charge a thing like you until they have the money in their hand, and like you, until their home is sold, you don't get paid. You do a lot of work beforehand, may take you a few weeks and you put some money in, sunk some money in, and sunk your time in, but until they physically get their check, and it's in their bank account, and they have their check in hand, they don't own any money. Now the last aspect, these new changes with respect to, you know, 4 units in a home, and developing new residential rental property with the rebate. The rebate's going to change. It's not been legislatively passed yet, but they will be giving back 100%. As I told you, it's 36. It's 36% to a maximum of $6,300. It's now 100% of all the GST that you're going to be paying on construction for new residential rental properties that a developer can get back. So if they're spending
That's for unit amount.
Exactly. The old rules still apply for single, duplex, triplex. For triplex, however, you can get 3 rebates on 3 rental properties in a triplex if they're, you know, brand new. On duplex and single, you can only get 1 rebate, and the same rules apply to those. But again, you know, the self-assessment rules still apply. So if you build a 4-plex, for example, if you buy a lot or whatever with an existing home on it for $1 million, you put 10 units on it. It costs you, let's say, I don't know, $5 million to build. You spent about $600,000 in HST, but now you've increased the value of that property, I don't know, $7-8 million potentially. So you owe 13% of that $7 million, which is what's it, $700,000, close to $910,000. You get to deduct, let's say, the $600,000, $650 you've spent on construction, so now you're at $240. You get back 5%, so you probably still end up in a positive situation. But in certain situations, you'll still end up owing the government money. Not as much as you owed before, but and that's why building real estate, residential rental property real estate is so expensive for builders, because there's a self-assessment that you have to do at the end, and you owe the government 13% of that. So something you build that's worth $10 million at the end, you owe $1.3 million. If it cost you $500,000 in HST to build, you can deduct that $500,000 against that $1.3 million, which is $800,000. And let's say you put in 20 units, each subject to a $24,000 rebate, which is $480,000. You still owe the government $320,000. But most of the bigger developers know this, and that's why new rental apartment buildings have not been built.
Yeah.
Yeah, you know, it's too expensive.
But they will be.
I don't think the huge ones will be built. I think the smaller, I think the gap is for those 4-plexes, 6-plexes, 10-plexes. I don't think you're gonna see new 200-unit buildings being built.
Well, 6 units is the magic number in GTA. Right, as soon as you go to 7, you're charged commercial.
Development
Five,
charges, yeah.
6 is commercial.
No, you can get 6, you can get 6. It's 7 that they swap over from residential tax to commercial tax, City of
Yeah.
Toronto.
They may change that, the city may come under some pressure to do that, but who knows with
But then,
this,
because then
with
you're.
this
If you
administration, I
build a
doubt
5-unit, place, you still pay residential taxes
Yeah,
for
yeah.
whatever crazy reason, but as soon as you go to like 6 or
it.
7.
Yeah, they somehow, yeah.
Then it's like.
I think it's 6, I think 5 is the
Used to be
stopgap.
6. Okay, but then there's like $30,000 in 76,
Yeah.
you know, like, just across
Right.
that.
Yes.
Question, I live in a purpose-built luxury rental building, about 200 units.
Mhm.
And it was built 8 years ago, and it was bought by, there was a low rise bought by the landlord from Gold List, okay? Now, they, are they responsible if they sell the 200?
No, it's used at that
It's
point.
used.
When they sell it again, well, no, it's commercial, if they, it's a business, so when
It's a
they,
business for them.
but it's used residential real estate, so no, it's exempt. It's exempt when they sell the whole building,
Really?
yeah.
Okay.
They let it wash, basically, because the buyer would have to pay HST, the seller would have to remit the HST, and they let those two wash. There's a special document that they get
Gotcha,
signed
okay.
to alleviate the paperwork.
But they pay at the time it was built. That one time.
They would pay at the
No,
time it
that
was
makes
built,
sense.
yeah. At the time it was built, they'd have to self-assess. So 8 years ago, when they built that building, they would have to self-assess. Now, I guess the numbers work for them. Anyway, that's basically it. You have my card. If you want samples of opinion and value letters, if you have clients who are interested, everyone here, please send me an email so I know, I've given out my cards, I don't know who I'm talking to, save for you. I'm sorry, I forgot your name. I'm sorry?
Phyllis.
Phyllis, save for Phyllis. And, reach out if you have clients interested. I can advise them. I don't charge any consulting fees. I will,
I just have one question.
Yes, go ahead.
Just wondering, when I, for example, sold my 1-year-old condo and I paid capital gain on it, why don't they question, like how they take 1 year to give you a rebate back? Why don't they question the rebate is not given?
You have to state, was it an investment property?
Yes.
You have to own it for 1 year. Otherwise, they would take it back.
Yeah, but that's the whole thing.
Yes.
So when I sold it, it
Yes.
was a rental, nobody questioned why you don't get the rebate back, but they can charge you the capital gain,
Two different
Departments?
two different legislations. One's the ETA. Had you sold it before 1 year?
No. But
No, had you
years-
sold it before 1
No,
year?
no.
No, I'm saying, had you,
Yeah, had.
you,
Had.
hypothetically,
Okay.
you would have had to pay back that rebate.
Oh, okay.
So you have to hold it, if it's a rental, you
Oh,
have to
okay.
hold it for a year before you
Yeah.
sell it, otherwise they will ask for that rebate back. Now, there may be some extenuating circumstances, if there was some more unforeseen activity, like let's say your renter, death in the family, they had to move out, let's say they got transferred to Halifax for a job, they had to move out.
Yeah.
Those are sort of, examples of when they probably wouldn't come after you. But here's an interesting glitch on the assignment issue, and I'll see if any of you know the question. So I buy as an assignor, or a young family let's say a couple buys a condo, and they're gonna move into it. And the interim before it closes, a 1-bedroom, and the interim before it closes, they have a child. And they can't move in, it's too small for them now. So they have to assign it and they sell it. Now, they bought it for $500,000, or they bought it for $400,000, they sell it for $600,000. Is the $200,000 of incremental subject to HST or not?
Yes.
No, it's the intention at the time of purchase.
The
They're
capital
very
gains.
not just the
HST.
intention. You'd have to prove it's your intention. But in this case, because they had a child and they couldn't move in too small, they would be granted exemption from that incremental. Now, if you had somebody say, yeah, I think I'm gonna move into it, but let's see how the prices go, right? And they buy it for $400,000, they sell it for $600,000, they would have to prove, if the government ever got, looked at this, the government assumes that 95% of these are flips as opposed to unforeseen circumstances, like a new child being born, move out of the city, huge financial problems, death in the family, divorce, that kind of thing, which are unforeseen activities that you couldn't control. In that case, in those kind of events, that incremental would not be subject to HST. And you would have to prove to the government, if they ever questioned you, as to why did you not decide to sell it. And you would have to say, well, you have to show them there was a divorce, there was a death, they're moving out of town, etc. In the absence of those conditions, that $200,000 is subject to HST, okay? And again, 99% of those agreements say HST is included in. The purchaser is exempt. They have paid it, they have implicitly paid it. I've gone to court on this and proved it, that this is, you know, it's a binding contract and it's been implicitly paid, regardless of what the statement of adjustment says. It doesn't break it out. And they will go after the vendor for that embedded HST on $200,000. So if you ever represented an assignor, make sure that they understand the consequence. I would say most of these get swept up. There's so many real estate signing, not so many now, but you know, over the last 10, 15 years, previous to COVID, there were a lot of assignment agreements in the GTA. I mean, people were just, hold on to it, you'll make $200,000, right? And most of them were probably missed, but the CRA has taken a little bit closer look now at many of these transactions, and they can come back at you after 2, 3, 4, 5 years. Right?
But not after 7 years.
Oh, yeah.
On the ETA, that's income tax. The ETA doesn't have any kind of,
HST is, I'll come after you forever.
yeah, they come after you forever. Exactly.
Thanks, Ronnie, that was
Okay.
really
Thank you.
Please reach out,
Thank
happy
you
to take
very
calls,
much.
happy to answer questions.
Very